trading in the stock market can be very profitable or painfully unprofitable. Many professional traders can make a few hundred to a few $100,000 a year, depending on the trader's competence and the trading system used. You can do it, too. You just have to know how. This video will guide you through the process of making investment decisions and put you on the right path to becoming a successful investor. Tips for investing in stocks. Number 1. During your wealth accumulation stage, consider overweighing stocks that pay low or no dividends. Lower yielding stocks tend to be safer, have greater growth potential, eventually leading to bigger dividends later, and save you on taxes. Number 2. Before buying stocks, you might want to try paper trading for a while. This is simulated stock trading. Keep track of stock prices, and make records of the buying and selling decisions you would make if you were actually trading. Number 3. Look for chances to buy high-quality stocks at temporarily low valuations. That is the essence of value investing. Number 4. Remember that you are not trading pieces of paper that go up and down in value. You are buying shares of a business. The health and profitability of the business and the price you will pay are the only two factors that should influence your decision. Number 5. Don't look at the value of your portfolio more than once a month. If you get caught up in the emotions of Wall Street, it will only tempt you to sell what could be an excellent long-term investment. Number 6. Buy companies that have little or no competition. Airlines, retailers, and auto manufacturers are generally considered bad long-term investments because they are in fiercely competitive industries. This is reflected by low profit margins in their income statements. In general, stay away from seasonal or trendy industries like retail and regulated industries like utilities and airlines, unless they have shown consistent earnings and revenue growth over a long period of time. Few have. Number 7. Wall Street focuses on the short term. This is because it is difficult to make predictions about future earnings, especially far into the future. Most analysts project earnings for up to 10 years and use discounted cash flow analysis to set target prices. You can beat the market only if you hold a stock for many years. Number 8. Be mindful of your biases and do not let emotion dictate your decisions. Trust in yourself and the process, and you will be well on your way to becoming a successful investor. Number 9. Companies with strong brand names are a good choice. Coca-Cola, Johnson & Johnson, Procter & Gamble, 3M, and Exxon are all good examples. Number 10. Invest in companies that are shareholder-oriented. Most businesses would rather spend their profits on a new private jet for the CEO than pay out a dividend. Long-term focused executive compensation, stock option expensing, prudent capital investments, a sound dividend policy, and growing EPS and book value per share are all evidence of shareholder-oriented companies. Number 11. Invest in tax-sheltered accounts such as Roth IRA or 401k and max them out each year before putting money into taxable accounts. You can save a great deal in taxes over the long run. Consider the following things before investing in stocks. Number 1. Invest only money you can afford to lose. Stocks can go down sharply over the short term, and even an investment that appears smart can go bad. Number 2. Do not attempt to time the market by guessing when stocks are ready to reverse direction. Nobody can time the market. Number 3. Do not use technical analysis, which is a technique for traders, not investors. Its viability as an investment tool is debated long and loudly. Number 4. Stick with stocks and stay away from options and derivatives, which are speculations, not investments. You are more likely to do well with stocks. With options and derivatives, you are far more likely to lose money. Number 5. When it comes to money, people may lie to save their pride. When someone gives you a hot tip, remember that it is just an opinion. Consider the source. Number 6. Do not buy stocks on margin. Stocks may fluctuate widely without notice, and using leverage can wipe you out. You don't want to buy stocks on margin, Watch stocks plunge 50% or so, wiping you out, and then bounce right back. Buying stocks on margin is not investing, but speculating. Number 7. Don't blindly trust the investment advice of anyone, especially someone who will make money from your trades. This could apply to brokers, advisors or analysts. How to establish your goals and expectations. Number 1. Make a list of things you want. To set your goals, you'll need to have an idea of what things or experiences you want to have in your life that requires money. For example, what lifestyle do you want to have once you retire? Do you enjoy traveling, nice cars, or fine dining? Do you have only modest needs? Use this list to help you set your goals in the next step. Number 2. Set your financial goals. In order to structure an investment plan, you must first understand why you are investing. In other words, where would you like to be financially, and how much do you have to invest to get there? Your goals should be as specific as possible so that you have the best idea of what you'll need to do to achieve them. Once you determine your goals, you can use the difference between where you are today and where you want to be to determine the rate of return needed to get there. Make sure you consider both your short-term and long-term goals. Number 3. Determine your risk tolerance. Acting against your need for returns is the risk required to earn them. Your risk tolerance is a function of two variables: your ability to take risks and your willingness to do so. There are several important questions you should ask yourself during this step, such as: what stage of life are you in? In other words, are you near the low end or closer to the peak of your income earning potential? Are you willing to accept more risk to earn greater returns? What are the time horizons of your investment goals? Number 4. Learn about the market. Spend as much time as you can reading about the stock market and the larger economy. Listen to the insights and predictions of experts to develop a sense of the state of the economy and what types of stocks are performing well. There are several classic investment books that will give you a good start. Number 5. Formulate your expectations for the stock market. Whether you are a professional or a novice, this step is difficult, because it is both art and science. It requires that you develop the ability to assemble a tremendous amount of financial data about market performance. You also must develop a feel for what these data do and do not signify. This is why many investors buy the stock of products that they know and use. Consider the products you own in your home. From what's in the living room to what's inside the refrigerator, you have first-hand knowledge of these products and can quickly and intuitively assess their performance compared with that of competitors. Number 6. Focus on your thinking. While trying to develop general expectations about the market and the types of companies that might be successful given present or expected economic conditions, it's important to establish predictions in some specific areas, including the direction of interest rates and inflation, and how these may affect any fixed income or equity purchases. When interest rates are low, more consumers and businesses have access to money. Consumers have more money to make purchases, so they usually buy more. This leads to higher company revenues, which allows companies to invest in expansion. Thus, lower interest rates lead to higher stock prices. In contrast, higher interest rates can decrease stock prices. High interest rates make it more difficult or expensive to borrow money. Consumers spend less, and companies have less money to invest. Growth may stall or decline. How to make your investments. Number 1. Determine your asset allocations. In other words, determine how much of your money you will put in which types of investments. Decide how much money will be invested in stocks, how much in bonds, how much in more aggressive alternatives, and how much you will hold as cash and cash equivalents, certificates of deposit, treasury bills, etc. The goal here is to determine a starting point based on your market expectations and risk tolerance. Number 2. Select your investments. Your risk and return objectives will eliminate some of the vast numbers of options. As an investor, you can choose to purchase stock from individual companies, such as Apple or McDonald's. This is the most basic type of investing. A bottom-up approach occurs when you buy and sell each stock independently based on your projections of their future prices and dividends. Investing directly in stocks avoids fees charged by mutual funds but requires more effort to ensure adequate diversification. Select stocks that best meet your investment needs. If you are in a high-income tax bracket, have minimal short or intermediate-term income needs, and have high risk tolerance, select mostly growth stocks that pay little or no dividends but have above-average expected growth rates. It's important to consider transaction costs and fees when choosing your investments. Costs and fees can eat into your returns and reduce your gains. It is vital to know what costs you will be liable for when you purchase, hold, or sell the stock. Common transaction costs for stocks include commissions, bid-ask spread, slippage, SEC Section 31 fees, and capital gains tax. For funds, costs may include management fees, sales loads, redemption fees, exchange fees, account fees, and operating expenses. Number 3. Determine the intrinsic value and the right price to pay for each stock you are interested in. Intrinsic value is how much a stock is worth, which can be different from the current stock price. The right price to pay is generally a fraction of the intrinsic value, to allow a margin of safety. MOS may range from 20% to 60% depending on the degree of uncertainty in your intrinsic value estimate. There are many techniques used to value stocks. Dividend discount model, discounted cash flow model, comparables methods. Number 4. Purchase your stock. Once you've decided which stocks to buy, it is time to purchase your stocks. Find a brokerage firm that meets your needs and place your orders. You can select a discount broker, who will simply order the stocks you want to purchase. You can also choose a full-service brokerage firm, which will cost more but will also provide information and guidance. Do your own due diligence by checking out their websites and looking at reviews online to find the best broker for you. The most important factor to consider here is how much commission is charged and what other fees are involved. Some brokers offer free stock trades if your portfolio meets a certain minimum value, or if you invest within a select list of stocks whose companies pay the transaction costs. Some companies offer direct stock purchase plans that allow you to purchase their stock without a broker. If you are planning on buying and holding or dollar cost averaging, this may be your best option. Search online or call or write the company whose stock you wish to buy to inquire whether they offer such a plan. Pay attention to the fee schedule and select the plans that charge no or minimal fees. Number 5. Build a portfolio containing between 5 and 20 different stocks for diversification. Diversify across different sectors, industries, countries, company size, and style, growth versus value. Number 6. Hold for the long term, 5 to 10 years, or preferably longer. Avoid the temptation to sell when the market has a bad day, month, or year. The long-range direction of the stock market is always up. On the other hand, avoid the temptation to make a profit even if your stocks have gone up 50% or more. As long as the fundamental conditions of the company are still sound, do not sell, unless you desperately need the money. It does make sense to sell, however, if the stock price appreciates well above its value, or if the fundamentals have drastically changed since you bought the stock so that the company is unlikely to be profitable anymore. Number 7. Invest regularly and systematically. Dollar cost averaging forces you to buy low and sell high and is a simple, sound strategy. Set aside a percentage of each paycheck to buy stocks. Remember that bear markets are for buying. If the stock market drops by at least 20%, move more cash into stocks. Should the market drop by 50%, move all available discretionary cash and bonds into stocks. That may sound scary, but the market has always bounced back, even from the crash that occurred between 1929 and 1932. The most successful investors have bought stocks when they were on sale. How to monitor and maintain your portfolio. Number 1. Establish benchmarks. It is important to establish appropriate benchmarks in order to measure the performance of your stocks, as compared to your expectations. Develop standards for how much growth you require of each specific investment in order to consider it worth keeping. Number 2. Compare performance to expectations. You must compare the performance of each investment to the expectations you established for it in order to determine its worth. This goes for assessing your other asset allocation decisions as well. Investments that do not meet expectations should be sold so your money can be invested elsewhere unless you have good reason to believe your expectations will soon be met. Give your investments time to work out. 1 year or even 3-year performance is meaningless to the long-term investor. A stock market is a voting machine in the short term and a weighing machine in the long term. Number 3. Be vigilant and update your expectations. Once you have purchased stock, you must periodically monitor the performance of your investments. Circumstances and opinions change. This is part of investing. The key is to properly process and assess all new information and implement any changes according to the guidelines set in the previous steps. Consider whether your market expectations were correct. If not, why not? Use these insights to update your expectations and investment portfolio. Consider whether your portfolio is performing within your risk parameters. It may be that your stocks have done well, but the investments are more volatile and risky than you had anticipated. If you aren't comfortable with these risks, it's probably time to change investments. Consider whether you are able to achieve the objectives you set. It may be that your investments are growing within acceptable risk parameters but are growing too slowly to meet your goals. If this is the case, it's time to consider new investments. Number 4. Guard against the temptation to trade excessively. After all, you are an investor, not a speculator. In addition, every time you make a profit, you incur capital gains taxes. Besides, every trade comes with a broker's fee. Avoid stock tips. Do your own research and do not seek or pay attention to any stock tips, even from insiders. Warren Buffett says that he throws away all letters that are mailed to him recommending one stock or another. He says that these salesmen are being paid to say good things about a stock so that the company can raise money. Don't pay too much attention to media coverage of the stock market. Focus on investing for the long term, at least 20 years, and don't be distracted by short-term price gyrations. Number 5. Consult a reputable broker, banker, or investment advisor if you need to. Never stop learning, and continue to read as many books and articles as possible written by experts who have successfully invested in the types of markets in which you have an interest. You will also want to read articles helping you with the emotional and psychological aspects of investing, to help you deal with the ups and downs of participating in the stock market. It is important for you to know how to make the smartest choices possible when investing in stocks, and even when you do make wise decisions you should be prepared to deal with losses in the event that they occur.